When interest rates rise, the value of your current bond holdings actually fall because you can buy new bonds at higher interest rates. And so is there a way that we can invest in something safer like bonds that we're not punished as much or maybe punished at all when interest rates are rising? So if we're in a rising interest rate environment, this is the video for you. So let's talk about three ways, two main ways and three different options as far as investing in bonds. And many times interest rates are rising because the central banks like the Federal Reserve Bank or the Fed are trying to fight inflation, right? So the big thing is actually inflation, rising prices, and to combat that, central banks will raise the interest rates to try to depress the economy, actually, and depress those rising prices and get those under control. But meanwhile, interest rates are rising. So one way you can do that is by looking at inflation-protected bonds, right? So inflation's going up, well, then you have bonds that adjust as inflation goes up. So it's adjusted with inflation. Now, because you're adjusting with inflation, these types of bonds have lower risk. And thus, if it has lower risk, you're going to find they're going to have a much lower return than maybe other types of bonds. So this is two of the options of the main categories: inflation, and we're going to talk about floating rate in a second. But then there's two options here. At least if you're a United States citizen, look at your own country as far as these similar types of things your country might have it. So one is to invest in Treasury. This is USA Treasury inflation protected securities, also known as TIPS. You can buy them directly from the U.S. government at treasury.gov. Both of these options you can at treasury.gov. And Treasury inflation protected securities are that. You basically are locked in at a rate and then adjusts. They have a base rate and then adjusts up or down based on how inflation is doing. So if inflation is rising, and thus this is a rising interest rate environment to try to continue to try to hold back that inflation. But if inflation keeps rising, the value of your bond resets and keeps rising too as well. So they do better in inflation rising environments. They don't do as well if inflation's really down or they're cutting interest rates, then they don't do nearly as well. They're more designed for inflation protection. And those will pay you a much lower rate of return. One that it's a lower risk, that'll pay you a better return. And we've done some videos on that, so do check out the homepage of mine. Do subscribe, that kind of stuff, and check out some of the videos around I-bonds. I-bonds are U.S. government bonds that give you a much better rate. They're over like 9%, that kind of stuff. They recently were at 9.62%, and they adjust every 6 months based on inflation, right? And so you lock in what you've made so far, and then each 6 months it adjusts up or down like with inflation, just like Treasury inflation protected bonds or TIPS. The catch with them, with the I-bonds, is there's limits. There's ways to get around this, but there's maximum of $10,000 that you can contribute in a year, and there's other limitations around that, like you can't sell your I-bond within 12 months, and there's other things even beyond the 12 months. But if you're looking to kind of get into something that's inflation protected and you certainly want to hold it for over 12 months, you might want to look at I-bonds. I certainly would say look at more depth of I-bonds before you buy them, because even if you sell before 5 years, there's a penalty. Check a look at some of my videos, or just look at other resources, or at USA Treasury at treasury.gov. The other type of bond that actually will give you a better return, because you're taking a little more risk than the U.S. government ones, is the floating rate as a floating rate note. Most people call them floating rate bonds, but technically a lot of times they're really called floating rate notes. It's really essentially the same thing to us. So floating rate notes or bonds are designed to perform well in rising interest rate environments. They are designed for when interest rates are rising. So these bonds have a variable interest rate versus like a fixed rate. When you buy a bond, you're locking in a fixed rate, except for those inflation protected ones like the TIPS and the I-bond. Other bonds, almost every other I-bond, you're locking in a fixed rate. Not with a floating rate bond, it is a variable rate. And it has an interest rate that fluctuates with the interest rates that's happening in the market, versus a fixed rate where that doesn't matter what's happening in the market, those are fixed. So what does that mean? That means there's lower risk to the investor and thus lower payouts too. But a lot of times you can get better, especially in a rapidly or rising interest rate environment. You can sometimes do better with a floating rate note, certainly better than TIPS. I would compare these to like I-bonds. And they're really tied to a short-term benchmark. The LIBOR is a short-term benchmark. I think it's a 3-month benchmark off the top of my head. You can always double check it. But the whole idea of a floating rate note or bond is that when interest rates rise, they do very well. When interest rates are falling, they do very poorly. So as you can see with these three options, traditional inflation protected securities or TIPS, I bonds, and floating rate notes or bonds, all of them are so tied to interest rates and or inflation that if you anticipate that interest rates will continue to rise or that inflation will still be a problem, then these might be the type of things to put into a portion of your portfolio. So just something to consider as far as there are options you can do even in the bond space when interest rates are rising. And oh, by the way, again, when interest rates rise and you're buying new bonds, you're buying at that higher interest rate. The problem is if interest rates keep rising above what you bought your bond at, the value of your bond goes down. Your interest rate's the same, but what you could resell it for goes down because it has to compensate for that rise in interest rates. It's just not as valuable. Again, I'm getting paid 5% on this bond, 3% on this bond. I have to discount the sell price for that bond if I want to resell it, let's say, in the open market. And exchange traded funds and all that, they suffer too because they're buying basically bonds like that. So long story short, if you think inflation is going to rise, then think about TIPS, I bonds, and floating rate notes or bonds.